Kia ora koutou katoa, everybody. Welcome. Now, if you are able to make sure that you can all hear me, that everything is working. Feel free to jump in the comments section and just give me a thumbs up and say, yep, that we're all good to go. We'll give it a couple of minutes to make sure that people can log in, they can hear everything that's going on. Wherever you are around the country, hope you're all well and safe. If you've either had your dinner or you've got yourself a nice hot or cold drink, ready to sit and join in on a conversation on diversification. It's going to be very much a bit of a Q&A. We've had some great questions come in, so I'm going to run through those. And then at the end, feel free to, or as we go, chuck in questions that come up. I'll try and answer them as we go, but definitely make some time to talk about anything that is of interest at the end. So do stick around to the very end because we can talk about other things other than diversification, whatever's on your mind. I'm obviously not going anywhere. If you can't tell, we're in Auckland, and so this is a bit of an example of a few weeks of lockdown, and looking forward to being able to get back out and reconnect with everybody. So we'll just give it a couple of minutes. If you do need to go and re-top up a drink or finish off your dinner, do that now, and we'll get started in a moment. I see a few people can clearly obviously hear me. Hi, Daniel, Raj, everybody that's out there. I've managed to get myself actually a lovely cold drink. It is a bit of a miserable night here in Auckland, but perfect for sitting on in and listening to a webinar, listen to me talk about diversification for half an hour. But like I said, we did have some fantastic questions come in that range from sort of what is diversification right through to some pretty technical questions. So we'll try and cover off a bit tonight. Hopefully I can articulate it in a way that's nice and clear. But again, do fire through any questions that you have. The team are here and we'll be able to answer those as we go or at the end. So while we kick into things, there was one question that came through that I thought was a good starting point. And it was, how do I approach diversification as a new investor with limited funds to begin with? And so, sorry, there we go. I'm already working the buttons. And I thought this was an easy one to start with, because the reality is that with index funds and today's technology, there are platforms and products out there that from the very first dollar you invest, you can actually be diversified. So I think you shouldn't be concerned about how much you have to get started. It's now accessible no matter what you have available or where you're starting from. The very first dollar you invest can be into a well-diversified index fund, and you're good to go. From there, for the rest of the night, we're going to talk a little bit about what is diversification, how you should think about diversification at different age stages, and how you can go about building a portfolio. At the end, yes, more than happy, Ritu, to cover off a little bit about managed funds, ETFs. Like I said, any other questions, maybe save them till the end so it doesn't, and that way we can come up to them and spend a bit of time on any other questions that you have. But before we get started, obviously, I guess the critical question, well, what is diversification? Ultimately, it's about spreading your investment around to reduce the volatility and ultimately improve your expected returns. And there are multiple layers to this. If you think at the very simplest level, if you put all your investment into one company, that's high risk. You're not diversified, and you'll always hear about, diversification is the only free lunch of investing, basically. If those that tune into our webinar that we did the other week, which was part of our roadshow, I touched a little bit on this, but if you haven't seen it, go back and have a look at it. It's on our YouTube, so you can go and watch that video. But I had a slide in there. I'm trying to recall the numbers off the top of my head. And what we did is we bucketed the returns from all New Zealand listed companies over a period of about 14 years. Now, about 17% of companies gave investors a return over that period, a negative 50% return, or went bust. So that's quite a high percentage of companies that give investors a pretty poor outcome. More interestingly, though, was we highlighted that about 75% of companies that were listed in New Zealand over that 14 years actually performed worse than average. And by average, we mean kind of the market. So that highlights a couple of things. It highlights that investing in one company is not a good strategy to get towards your investment goals. You need to be diversified. And actually adding more companies and being more diversified actually improves the probability that you have of getting a better expected return. So that first layer is obviously about making sure that you're diversified across multiple companies. The next layer to that is ensuring that you're diversified across a range of sectors. So you want to be diversified across, technology, healthcare, utilities. COVID is a great example. Different sectors will perform different during different periods. And COVID has highlighted that there are unexpected things that can come along that have significant impact on tourism or hospitality, while other sectors may thrive. Diversification across sectors ensures that you're not too exposed to one single outcome, because you're not diversifying and not reducing the alignment of outcomes. That equally applies to countries. You want to be spread across a range of geographies: US, New Zealand, Europe. In 2017, Austria was the best performing developed equity market. The next year, it was actually the worst. Highlights why you need to be spread across. Now, part of that as well is ensuring you're also diversified across asset classes. So that means that you're not only investing within equities and diversifying within your equities, but also that you've got property, infrastructure, potentially bonds. And so we're going to talk a little bit about those differences and how you go about building that as we go along. One of the other questions that we had come in, though, was how much diversification is too much? I guess the key message here is you don't need to over-engineer it. It's the same with investing generally. One of the philosophies that we really stand for here is that you don't need to build the most complicated looking portfolio and invest in dozens of funds. A couple of funds, particularly well-diversified index funds, and you're actually gone most of the way there. If you go and look on our website now, we've actually launched a couple of bundles or portfolios that you can invest in. One of them is a high growth portfolio. It's got 6 funds in it, and that's actually pretty much all that most people would need to get towards their investment goals. It's a great combination. It is global diversification spread across a range of sectors, and so with a few funds you can actually go a long way there. And I guess the other thing that we see about that is sometimes I guess people come to us and go, well, do you need more companies within a fund to be diversified? Sometimes people go, well, do I need a total world fund? And there are a range of total world funds out there, and some of them have got 5,000 companies, 10,000 companies, 15,000 companies. Now, the reality is, though, that in those funds, 60, 70, maybe even 80% of the performance and the volatility, the ups and downs and the risk, all come from those first few hundred companies, because they'll often be market cap weighted. And by that, the bigger the company, the bigger the weighting in the fund. So the fund will actually be most of the performance, most of the risk, most of your diversification, all of that comes from actually those first few hundred companies. When you add in the 1,001 company, you're not actually changing anything really within the fund. It's not really improving the diversification, because you've already got spread across a range of countries and a range of sectors and a range of companies. It's not adding much. Actually, the only thing it's adding is cost. That's the only surety that you have, because there's transaction costs with that. The same goes if you're trying to build an individual portfolio for yourself out of direct shares. Buying 1,000 direct companies comes with a lot of transaction costs and a lot of fees, and that 1,000th company isn't actually going to change much of your portfolio. So you can get over diversified where it's not actually adding much. Again, so keep it simple. One of the questions also that came in as part of that was, I only have $100 a fortnight that I can spare. How thin should how thin should I spread that money across different funds? Again, coming back to the technology benefit, even if it's $100, you can spread it across as many or as little companies as you like. The dollar amount almost doesn't matter anymore, because you can divvy that up as small as you like, as across as many strategies to suit your own goals. But like I said, don't need to over-engineer it. You don't need to go out there and invest in every single option that exists. And I think that's one of the interesting things that we do see is sometimes we're seeing people go and buy 15, 20, 30 different funds, and each of those ETFs or index funds may actually, are all likely to be well diversified in of themselves. one of the unintended consequences of that may be actually that you all of a sudden have a greater concentration in a sector or a company that you weren't intending to. Take New Zealand as an example. If you went out and bought every New Zealand equity index fund or ETF, and you bought all of them and invested in all of them, there's a lot of double up with some companies in there. So what you may not realize is that all of a sudden you've got a lot more than you intended as a percentage of your portfolio in one or two companies or in a single sector. So again, you want to try and avoid the overlapping, because all you're doing is potentially creating unintended consequences and also creating costs. And so just try and balance it out. You can keep things relatively simple. One of the other questions that we had come up, which is actually highly debated in our office, is my house an emergency fund counted as part of a diversified portfolio? Well, in short, we would say no. While we do debate it, these are assets. Your house technically is an asset, so is your emergency fund, but they have a wider purpose other than being an asset. And so separate those out from how you're going about thinking about your investments, how you're structuring, and how you're trying to build diversification. I would tend to go and make sure you've achieved that, particularly for your emergency fund, right? You want to ensure you've got your emergency fund, and then you can start thinking about your investments and diversifying from there, because you may still want to have cash as part of your diversified portfolio. And we'll touch on that coming up. So this is probably the more technical question that we had come through, and I think it's a kind of relevant one. And there are a few layers to this, so hopefully I can break it down. Is there any set rule for diversification? Should you have 20% in property, 20% in New Zealand shares, 20% international? And what about alternative assets? So there are a couple of things in here. I'm going to try and unpack them, and do fire through with comments if none of that's quite clear. Yes, there are some rules and structures about how a lot of asset managers, fund managers, KiwiSaver providers will go about constructing a diversified portfolio. If you went and had a look at most of the high growth KiwiSaver products in the market, or high growth diversified funds, you'd probably see a lot of alignment. They've probably got 60% or so into international shares, 20, 25% into New Zealand. They'll have 5, 6, 7% into some listed property and into some listed infrastructure. They're fairly consistent. In fact, you can actually go and have a look again at our high growth bundle. It's designed to reflect a pretty standard high growth asset allocation. So it's a split between those different assets that you can go and check out. It's a one-click stop shop type thing. So if you just want to get started, it's a great spot. That's kind of underpinned by a lot of academic theory around trying to balance the correlation and the risk return of the different asset classes. And you go and look for modern portfolio theory, that will give you some basis for where a lot of that comes from and the academics behind it. But probably stepping back, the more critical question before you even start thinking about how much goes into property and how much goes into international versus New Zealand, the really key question actually that is going to have a far bigger impact on your expected returns and getting towards your goals is the simple split between how much you want into growth assets and how much you want into income assets. The growth income split. So that's in the growth bucket, you've got shares, and that can be listed property, infrastructure, and company shares. And then in the income bucket, you'll have, so that's your fixed income part of the portfolio, that's your bonds, term deposits, and cash. That's the critical split. Now, for a long period of time, a lot of advisors, a lot of investors actually had what's called a 60-40. So 60% into growth and 40% into income assets. Then within each of those buckets, you would go and do that little splitting up between international shares, domestic shares, property, etc. Now, for a very long period of time, that's worked. In fact, for 40, 50 years, it's been great. Another name for 60-40 is a balanced portfolio. So if you're more familiar with KiwiSaver, You'll be familiar with the terms if you've gone and used the sorted website or looked at your KiwiSaver, which hopefully everybody has. You'll have conservative, balanced growth, high growth. So conservative, obviously a large percentage is into those income assets, cash and term deposits and bonds. Balance, typically 60-40, a growth maybe 20% into bonds and term deposits and the rest into equities. Now, for about 40 years, interest rates have been falling, and that's been great for a balanced portfolio because typically a lot of the assumptions are when building a portfolio is that, if shares fall, bonds may rise and vice versa. The correlations, help support that they have a diversification benefit together. And that has broadly been true. The other benefit has been that when interest rates have fallen, the value of the bonds has also increased. So investors in a balanced portfolio have been able to smooth the ups and downs that they would have had if they were only invested into shares, but have been able to get quite a good expected return. But now we're in a situation where interest rates are at record low or at zero in a lot of places, and are potentially going to rise. And that fundamentally changes that equation for the first time in a generation. And how people tended to go about diversifying and thinking about that split was often associated, what the key question really is when do you need that money? So your age and stage. If you're young, maybe you've already bought your first home, you've got a long investment horizon, most of your money would go into growth assets. That's the pretty standard approach. As you got closer to retirement, you get 50 or 60, you'll start to increase the amount that you have into the income part, the bonds and term deposits and cash. But now in this new environment, that may no longer work, particularly for people in retirement. You can no longer live off an income source from bonds or term deposits that pay 1% or less, and that's before you take out fees and taxes. So a couple of things are changing there about how you think about this diversification. This is kind of this first layer of the diversification before you then go and split up into the next piece. And so you want to really think about that. And now the key question is to help determine what that split should be for you is really, what is your investment horizon? When do you need the money? If you've got time on your side, so you've got 5, 10, 15 years before you need that money, you can afford to have a higher allocation to the growth part, the shares. If you need the money in the short term, you need to know that the money is going to be there when you need it. If you're buying a house and you're planning to buy a house in the next couple of years, you can't afford to be fully invested into shares, because what happens if the market fell and then the day comes that you need to buy the house, you don't have all the money that you really need. But people need to realize that sometimes their horizon is a bit more flexible than they really thought. If you think about retirement, it's not like at 50 or 55, we go, I'm going to start needing some money soon, or I'm going to hit retirement in 5 or 10 years. I better put all of my money into income assets, because you don't actually need all of that money on day one when you get to retirement. In fact, some of it you may actually not really need to touch for 20 or even 30 years. So you have time to ride out the ups and downs. So it's a bit to unpick there, but really what I'm saying is that the split between bonds and shares is changing, and people are starting to go, actually, I need to be invested more. And then what you're doing is saying, actually, any money I need in the short term, I'll put into term deposits or cash. And we're seeing this with economists and others around the world. I don't know if anybody's ever read A Random Walk Down Wall Street. But Burt Makel, that was the writer of that book, The Economist, his original portfolio, I think, from when the book was written, was something like 30% or 35% into bonds, some cash, and the rest shares. In recent interviews of the last few years, he has even been saying himself that 95% into shares and 5% into cash, because the world has changed a bit. Once you get to that layer, once you're comfortable about when you need the money, how much of it needs to be for short-term purposes, how much do I need to have to smooth out the ups and downs? So do I need any money at all in these sort of more conservative income type assets, or can I afford to invest the rest? Once you've solved for that piece, then you can start thinking about what this question originally came to, which is how much of that should I have in the different buckets within that category. So if we focus on the shares piece, how much should I have in New Zealand shares? How much should I have in international shares? How much should I have in listed property, listed infrastructure? Coming back to it, typically our high growth portfolio, which you can look at on our website, is an example of just an equity allocation, and we have in that portfolio about 60% into international, which is fairly standard, and I think about 20-25% is into New Zealand, and the rest is property and infrastructure. That's a fairly industry standard split between those two, between those different buckets. So hopefully that gives you a couple of things to think about. The first, obviously, when do you need the money? What's your investment horizon? That's going to help determine what is the split between growth assets and income, and really question how much do you need in income and when do you need that money? Because in a low interest rate environment and with interest rates potentially rising, the income part of the portfolio and putting your money into term deposits and bonds may not give you the diversification benefits you need, may not smooth the ups and downs as expected, and is going to give you a fairly low return. And if you've got time on your side, you can think about how you're going to manage that growth part. Then think about the separate allocations. So quite a long-winded answer, but hopefully that's kind of covered off a little bit of the splits. Do ask any questions that you got if that wasn't clear, because it's quite a complicated one to unpack about how you should split each of those. But if you do want some examples, have a look at our high growth bundle, because that's a good example of how you could split investments. That's a fairly standard kind of split. And again, that's available on the website, just so you can go and see all the countries and sectors as well. Finally, alternative assets. Where does crypto and other things sit into that? One of the things I think you've probably heard us talk about many times before is core satellites. These alternative assets are your satellites, depending on how comfortable you are and what your risk tolerance is. So how comfortable you are with the ups and downs, which ultimately is underpinned by when you really need the money, is 5%, 10%, whatever your tolerance is or comfort is with that. These should be small allocations, small part of the overall wealth, because they're likely to be more volatile, probably less diversified, but they can have a role to play. And so, they can fit within a portfolio. It's up to you as an individual about what you're interested in, but make sure that it's typically a smaller part. So hopefully that's unpacked that. Again, another quite technical question that we had come through was, is Markovitz Efficient Frontier used in practice within diversification? So this comes back to what I was talking about just before in this asset allocation. So the Markovitz Efficient set of portfolio is basically the combination of asset classes and portfolios that you could build across different risk or volatility levels to maximize kind of your expected return for that level of risk. So if it was that conservative portfolio, it's trying to find that most optimal combination of the different asset classes for that level of volatility to give you the highest expected return. Is it used? Yes, it is. Ultimately, it does underpin a lot of what's going on in today's investment landscape. But don't forget, it is academic still. And so there are a couple of conceptual issues with it generally, is that it relies on inputs. So anything that's a model that relies on inputs is going to be heavily impacted by assumptions. And they often prove to be wrong. Look at any economist forecast or any weather forecast. Things typically don't turn out as they were planned. The other big issue with it is calculating this efficient frontier and the combination of the different asset classes within each risk level is basically a snapshot at a point in time and assumes the correlations are static. And so by correlations, what we're talking about there is if you had two assets or multiple assets, the correlation is how do they move together. So if they're perfectly correlated and they went up together, they'd go up like together like that. If they're not, one may do that and the other may go down. You actually want things in your portfolio that aren't perfectly correlated. You don't want a portfolio of everything that goes up, because at the same time it could all go down. What you want is things that aren't correlated, so that when one's going up, the other may be down, but they're going to smooth each other out a bit, and that will improve your expected return. So the problem is, though, with the efficient frontier model, though, is it's assuming that those correlations are static and they change all the time. When I talk about 60-40, the main assumption that most people think about is that if shares fall, bonds will go up. typically that has been fairly common, but it's not always the case and doesn't always hold true. There are periods where bonds and shares both go up and both go down. And so some of the flaws of the academic piece is that they don't necessarily apply perfectly to the real world. And so I think with anything, come back to keeping it relatively simple. The biggest question I have at the moment more is this asset split, and really getting people to think about that, of going, actually, how much do I need into fixed income, and really what is my investment horizon? To me, that's the biggest piece right now for people to be thinking about. How do I ensure my portfolio isn't unintendedly concentrated towards big tech? So we had somebody email in and they said, look, they've got a diversified portfolio. They're following a core satellite strategy, which looked fantastic. That's great to see. They've got some allocations to thematics, but they're smaller percentages, which, you know, you're off to a great a great start. And I think building a well-constructed portfolio. But nevertheless, they say they find a significant portion of their money, circa 16%, is invested in US technology companies. Now, while I recognize these are big companies that are doing well at the moment, they're fairly new in the grand scheme of things, and there's really no guarantee how they'll perform going forward. That's true. Technology makes up a large portion. I think a couple of things with this. One is, if you're investing in a index fund that represents a part of the market, so not like a thematic index fund or a sector, but like a Global 100 or an NZ 20, they're actually self-cleansing. So as sectors and companies perform better or worse, some may drop out of the index or become a smaller percentage, while other sectors that perform well become a larger percentage. So over time, you have this natural self-cleansing going on. And so it will ride through any ups and downs and sector changes and dominance changes as different sectors perform better and others perform worse. So again, having a market cap index is a kind of a good building block. The other thing to think about is, yes, they are quite concentrated. We have had this level of concentration before. So the top 5 largest names in the S&P 500 at the moment, which most people know, the Amazon and Apple, we have had similar weightings. So in the 1960s, the top 5 largest names in the S&P 500 accounted for about 28% of that index. So we've had periods in time. It's not unusual to have large companies be quite a significant part of the market. In fact, IBM at one point was 10%, so quite a big percent from one single company. Probably one difference is that in the 1960s, when you had those 5 big names at about 28% of the market, they were actually all in different sectors. So you had Exxon and IBM, etc., in there. So you had different sectors making up that. Now it is dominated by technology. So that potentially is something to be considerate of. In saying that, though, we are in a technology world. The world has changed. Technology is underpinning our lives, and we're in the 4th industrial revolution, and is fundamental to how the world is going to be moving forward in our economy. And so I think as long as you've got a diversified portfolio and the technology weighting as your total portfolio looks realistic and you're comfortable with that, I think that's fine. Again, if you look at our high growth portfolio, I think you need to check it on desktop, but you'll see, I think about when you combine those 6 funds together, about 18%, I think it is, of the total portfolio is in technology, which is probably, in my personal view, about right. But if you are concerned about those things, that just comes down to how you combine different funds. You could add in different sector funds or different assets to try and balance that out and go to reduce that to something that you're interested in. And so it comes down to then your personal decisions around how do you want to go about investing. Do I need to diversify between fund managers? And if so, by how much? Now, the question really was kind of talking about, they said different providers. I've assumed fund managers here, but it could be different platforms. If we're talking about fund managers, I'd say you should take great comfort in the regulatory environment we have in New Zealand. So all fund managers who have a product disclosure statement, a PDS, like Kernel, like your KiwiSaver schemes, pretty much all operate the same. We've all got a supervisor, an independent custodian. We're regulated by the FMA. The structure is the same pretty much for every single retail licensed fund. And the regulatory environment in New Zealand is fantastic for that. And we've written a blog on it that gives a visual breakdown of all the different parties and how everything is segregated and the oversight that you have. So I think you can take great comfort that New Zealand is a well-regulated environment, that you shouldn't have concern. And equally, if something actually ever happened to even a big bank or an independent fund manager, the assets within the funds are ring-fenced and separate. So it's completely separate. You do need to be conscious, though, if you're looking at, if you're a wholesale or an eligible investor, in the sense that you're investing into wholesale funds. Wholesale funds don't have that regulatory scrutiny. They don't have to have the supervisor or independent custodian. They're very much out of the standard regulatory scrutiny. So that opens up some additional risks that you really need to be conscious of. And the same with when you start using offshore providers. Ultimately, you're in another jurisdiction. If something happened, it's a lot harder to take any claim. And just check some of those things, particularly if you're using offshore platforms or they've got funny custodial arrangements or offshore partners. You just want to be confident and understand exactly what those relationships are. But if you're thinking about New Zealand and fund managers, no, you don't need to just have, I think in their scenario, should you only have 10% with any one provider? Look, from a fund's point of view and a risk point of view, no, that doesn't really make any difference. Conscious of the time, I want to answer any questions that you have. We had a couple of other questions here. Do the Kernel Global 100 and New Zealand 20 cover any emerging markets? No, they don't. But with the Global 100, I would talk about emerging markets generally in that these are 100 companies around the world that are operating in pretty much in every market. So they will have products and services that are being sold and a big part of emerging market economies too. So indirectly, you are getting this very global exposure. These are some of the biggest brands and products that you will know around the globe, from your Moët champagne to your Colgate toothpaste. Actually, if you go and look at these global companies spread across these global exchanges, you quickly realize how much of the world is dominated and owned by these 100 companies. And I think some of the numbers that I've seen is these 100 companies actually account for, depending on where you cut it, between sort of 35, even 40% of the world developed equity markets. They're a big part of the world economy. Finally, I think one of the last questions I had come up here was, what is the ideal mix between cash, equity, property to give you a net return of 5%? It's a pretty simple answer for me. Anybody that guarantees you some sort of return, take it with a grain of salt. You really should be very cautious. Nobody can predict what is going to happen. The whole point of being diversified is to ensure that you've got a well-built portfolio that will get towards your long-term goals. 10 years, it sounds like you've got time on your side. It's just a question of, you're probably not going to necessarily get 5% every single year, because there are going to be ups and downs. So, and there's not many options out there now. You can't get term deposits that pay you 5% that you know you're going to get 5% every year. So you'll have to think about how you're going to build that, and you may want to think about what are your priorities and what are you trying to get out of your goals. So any questions? We've covered off quite a few things tonight, some of them quite technical, but hopefully you've been able to take something away from it. Like I said, we've got a couple of blogs on these things that talk about diversification, that talk about the split between New Zealand and international. I guess just quickly on that, New Zealand is 1% of the world equity markets. We're just a fraction. We're a small little spot at the bottom of the world. And people often go, well, should I invest all of my money offshore then? You can't discount, though, that pretty much every investor around the world in every market has a home bias. They invest more in their home market. And that's because of tax and costs. It is more efficient to invest locally than it is offshore. And so that incentivizes you to be invested locally in your local currency, where you spend and earn your dollars. You don't have the transaction fees or the foreign exchange fees, and you've got a better tax structure. Hence why you'll still see, a lot of investment portfolios in KiwiSavers with 20 or 30% into New Zealand shares, because of those benefits and efficiencies. So any questions, fire through with any questions that you may have. I'll just kind of quick look back to see. One of the questions was managed funds and ETFs. We'll cover, hopefully I've given you some examples, but if you've got any specific questions, do send them through. Why were the Kernel, Andrew here, why were the Kensho, Moonshots and EV excluded from your growth package? Great question. Because we see them as satellites. So when we think about this core satellite portfolio, the core is actually all you need to get to your long-term goals. So you personally may want to have 60% into your core and the rest into other assets, or maybe it's 80% or 100%. By not having them in the bundle, it gives people the choice, the personal decision, because the core is what a lot of people will need to get to their goals. Satellites and thematic funds are a personal decision, depending on how comfortable you are with the volatility or what your views are. And so that gives you the ability to then add them on based on your own decisions and own views. What are your future fund plans? Look, we've got a few concepts, but we do welcome feedback. So do send in any ideas. It has been a big part of how we've built our product range to date, working with our investors across the board. So send through any concept ideas that you have. And look, it does genuinely get considered and discussed pretty robustly by our team. And we do record down what everybody's suggestions are. So welcome to send those through. And is there time we can talk about the Kernel Kensho funds? Catherine, happy to answer any questions that you've got on that. Was there anything specific that you wanted to know? I guess the two Kensho funds that we do have are our Moonshots and the EV. The Moonshots, in terms of the sectors it provides exposure to, is similar conceptually to ARK. From when I last looked at it, it's actually outperformed ARK. Kensho is an artificial intelligence company, basically. They've developed a range of machine learning. And so unlike a lot of traditional indices where an index may be trying to get the largest part of the market or a certain sector, these are looking for companies within a specific theme. And particularly what Kensho is looking for are companies that are part of our new economies: space, genomics, autonomous vehicles, and clean energy. And the Moonshots is trying to find 50 of the most innovative companies that they filter through by using artificial intelligence, basically machine learning, to scrape financial statements and earnings calls to find companies that are playing a big role in that or are significantly invested into that. Same when it comes to EV, it's about companies that are significantly involved in our shift towards a renewable transportation future, basically. So a couple of those funds there, like I say, we see those as thematics, and these are satellites. So they would sit alongside a core portfolio and up to a personal choice. Any other questions? That more than happy to answer anything that came through, but look, appreciate the comments that we have come through and everybody taking some time out this evening. Like I said, if you didn't watch or haven't seen it previously, do have a look at our last webinar where we talked a little bit about the balanced portfolio and thinking about growth versus income, and send us through your questions. We are stuck at home for at least another week. Questions, phone calls, we're here, our team's available, and love having a chat. So if that's all for tonight, hopefully you can go enjoy the rest of your evening, and we'll chat again soon. Perfect. Thanks, everybody. See you next time.